President Trump has once again embraced tariffs as his weapon of choice in the global trade arena. On April 2nd, 2025, he announced sweeping new tariffs on imports from a range of countries, including China, Mexico, and Canada. The move sent shockwaves through the global economy, reviving fears of a trade war and raising questions about the administration's commitment to free markets. The stated goals of these tariffs are threefold: reducing trade deficits, curbing the flow of fentanyl into the United States, and bolstering national security. The tariffs, however, have been met with a mixture of skepticism and alarm from economists, business leaders, and foreign governments. Critics argue that they will harm American consumers, businesses, and the overall economy, while doing little to address the underlying issues they purport to solve. They also warn that the tariffs could backfire by provoking retaliation from trading partners, leading to a downward spiral in global trade. The reaction from financial markets was swift and negative. The Dow Jones Industrial Average plunged over 10% in the 2 days following the announcement, wiping out trillions of dollars in market value. Investors, already jittery about rising inflation and slowing economic growth, interpreted the tariffs as a sign of instability and uncertainty. The tariffs have triggered a $5 trillion portfolio bleed since their announcement, reflecting a deep-seated anxiety about the future direction of the U.S. economy. This exodus of capital underscores the high stakes involved in the Trump administration's gamble. The tariffs represent a significant escalation in the president's confrontational approach to trade, and the consequences for the global economy could be profound. Whether these tariffs will achieve their stated goals or simply exacerbate existing tensions remains to be seen. The Trump administration's rationale for the tariffs rests on three main arguments. First, they argue that tariffs are necessary to reduce the U.S. trade deficit, particularly with countries like China and Mexico. Second, they contend that tariffs will enhance national security by reducing reliance on foreign supply chains, especially for critical goods and materials. Finally, the administration claims that the tariffs will create jobs in the United States by protecting American industries from foreign competition. These arguments, however, are based on a flawed understanding of how the global economy works. Tariffs are a blunt instrument that often produces unintended consequences. While they may provide short-term benefits to certain industries or sectors, they inevitably harm others and impose costs on consumers in the form of higher prices. One of the most dubious claims made by the Trump administration is that tariffs will lead to a resurgence in American manufacturing and create jobs. The reality is that the U.S. economy is currently facing a severe labor shortage, with unemployment rates at historic lows. Manufacturers are already struggling to find qualified workers to fill open positions, and tariffs are unlikely to change that. In fact, tariffs could exacerbate the labor shortage by raising costs for businesses and making it more difficult for them to compete. Instead of bringing back manufacturing jobs, the tariffs could accelerate the trend of automation as companies seek to replace increasingly expensive human labor with machines. The price of protectionism. Consumers foot the bill. The most immediate and predictable impact of the tariffs will be higher prices for consumers. Tariffs are essentially a tax on imported goods. Those costs are typically passed on to consumers in the form of higher prices. This will disproportionately impact lower-income households who spend a larger share of their income on goods and services. The Tax Foundation projects that the tariffs could cost consumers $258.4 billion in 2025, or approximately $1,900 per household. This increase in prices will further fuel inflation, which is already at its highest level in decades. The Federal Reserve may be forced to raise interest rates more aggressively to combat inflation, which could slow economic growth and potentially lead to a recession. In short, the tariffs are a recipe for economic instability and hardship for American families. A world adrift supply chains and dollar dominance. The tariffs also have the potential to disrupt global supply chains that have been built up over decades. Many American companies rely on complex networks of suppliers around the world to produce their goods. Tariffs disrupt these networks, forcing companies to find new suppliers or relocate production, which can be costly and time-consuming. The disruption caused by the tariffs could lead to shortages of certain goods and increased costs for businesses. Moreover, the tariffs risk undermining the US dollar's status as the world's reserve currency. Countries like Russia and China have been seeking alternatives to the dollar for years, and the Trump administration's aggressive trade policies could accelerate this trend. A decline in the dollar's dominance would have significant implications for the US economy, making it more expensive to borrow money and potentially leading to higher inflation. The deep roots of trade friction. The Trump administration's focus on tariffs as a solution to trade imbalances ignores the complex underlying issues that have contributed to the current state of affairs. The US trade deficit is a symptom of deeper structural problems such as low savings rates, high levels of government debt, and a lack of competitiveness in certain industries. Similarly, the issues of intellectual property theft, drug trafficking, and supply chain vulnerabilities cannot be solved by tariffs alone. These are complex challenges that require a multifaceted approach involving diplomacy, law enforcement, and strategic investments. A smarter arsenal, precision over bluster. Instead of resorting to blunt instruments like tariffs, the US should pursue a more nuanced and targeted approach to addressing its trade concerns. This could include negotiating new trade deals that address specific issues like intellectual property protection and forced technology transfer. It could also involve working with allies to pressure China and other countries to play by the rules of the global trading system. The US should also focus on strengthening its own economy by investing in education, infrastructure, and research and development. By making American businesses more competitive, the US can reduce its trade deficit and create jobs without resorting to protectionist measures that harm consumers and businesses alike. The perils of economic nationalism. The Trump administration's embrace of tariffs is part of a broader trend of economic nationalism that is sweeping the globe. From the US to China, countries are increasingly turning inward, prioritizing their own narrow interests over the need for global cooperation. This inward turn is driven by a number of factors, including rising inequality, anxiety about globalization, and the resurgence of populism. However, this retreat from globalization is a dangerous path. A world divided by tariffs and trade barriers will be a poorer, more conflict-prone world. The US, as the world's leading economic power, has a responsibility to champion a rules-based international order that benefits all countries, not just itself. The Trump administration's tariffs are a step in the wrong direction, and they should be reversed before they cause lasting damage to the global economy. Let us know what you think about this topic. If you found this material valuable, please like and subscribe to the channel. It really helps. The views relayed in this video are that of evervests.com and should not be taken as financial advice. Please consult your financial advisor before making financial decisions.